Okay, in this video we're going to review something that we talked about over the weekend, and I was asked a few times to record the difference or record a video explaining the difference between what I'm doing with the breakout strategy on the 1 hour time frame and what I'm doing with the reversal trades and those indicators on the 1 hour time frame. So I've made quite a few videos over the last few weeks and months, and you most likely have seen in some situations with the breakouts the 1 hour time frame and then the reversals the 1 hour time frame, but I'm using different indicators. So I'm going to review the different indicators, why I'm using those indicators and the settings for those indicators. And then I'm going to talk a little bit about when I actually decide to take a trade, like what is a valid trade for me. Now, I'm not going to break down the details. First of all, we're going to start off with the breakout strategy. And so in another webinar, we'll talk about the breakdown of how to qualify consolidation to use this strategy on the 1 hour time frame for the breakout trades. I'll talk briefly about the take profit levels, the targets and the stop loss placements for this one. But again, we're going to go through it quickly. I just want to show you the setup on the 1 hour time frame and then the indicators and why I'm using the indicators and then when I decide to get into the trades. So this is for the reversals. I'm going to go to the breakout page first. This is the 1 hour time frame for the breakout. So I'm going to open up the euro dollar chart. So the euro dollar chart, this is the 1 hour time frame. Now, I use the breakout strategy. I teach how to use it on a 4 hour and a daily chart. So you can use it for swing trading. But I like to day trade. A lot of people like to day trade. And that's how I primarily developed the continuation breakout trade, was because of the fact that I was day trading. I was looking for a good solid day trading method. Generally, I'm thinking or would like to see the trade reach its take profit target within the same day. Or the same session. Sometimes I have to wait one session or two sessions, and then every once in a while things just go sideways. Nobody can really anticipate that, but you get these breakouts and then the market just stalls. It reacts to it. You get a breakout, it gives you an entry, goes up maybe 15, 20, 30 pips, but then it goes sideways for a while, maybe 2 or 3 sessions, and then sometimes later on it'll pick back up again, maybe the following day, and then it'll move to its take profit level. So this is, again, on the 1 hour time frame for day trading. The 1 hour time frame, I don't use the continuation breakout trade on the 30-minute chart. And I'm going to explain why. So when I'm going to go back over here to this range of consolidation. Let's go ahead and use this one here. So you'll notice this range of consolidation right here. And you can see, again, if this is a 1 hour time frame, this has been in place for a couple of days, this consolidation range right here. I'm going to go ahead and put the crosshairs in here. There's the high, there's the low. It's just kind of bouncing around in there. Now, one of the things that, and I talk about this, one of the situations that happened to me pretty often in the beginning of my trading career, I joined a chat room, and when we would sit there, and the chat room was open 24 hours a day. They had an Asian session, London, and New York session, and they had traders that would call out trades for different sessions. And when we would find ranges of consolidation like this, sometimes they would try to pick scalping opportunities in there. And if there was news, let's say during the London session, they would try to decipher, these chat room moderators, they would try to decipher the news themselves and then try to call a trade. Very often they wouldn't go anywhere. I don't think that they were always using trigger numbers because they never really talked about it back then. And very often we would get into these trades, it would go nowhere. They would just stall. So the first thing to remember is that not every economic report is going to give you a trade opportunity. You have to wait for the numbers to be released and then know and understand that deviation in the expected numbers compared to the actual numbers. And then is it likely to actually have an impact? Because sometimes some reports, and you probably already know this if you've been trading the news, for example, non-farm payrolls or jobless claim numbers, things like that. Sometimes they have an impact on the dollar. Sometimes they don't. It depends on the timing or the cycle, interest rates, and how it's going to have an impact on the dollar. So you have to be aware of at what point, what cycle we're in with interest rates. There's different cycles. There's business cycles, interest rate cycles. You have to be aware of those. So again, sometimes a good number isn't necessarily positive for the dollar, and other times a good number is. You have to be aware of that. So that's what I'm getting back to, is that a lot of these chat room moderators didn't know. And if you don't know, that's okay. Then just stay away from it, right? If you don't understand the impact of the report, then don't take the trade, because then you're just chasing price. You don't know how far it's likely to go. If you don't know the numbers and the likely or the chances that it's going to affect the dollar or the euro or the pound or whatever you're trading in a more significant way where it's going to continue to trend afterwards, then how do you know where to take your profits, right? You're just chasing price up and down and hoping to just scalp something. And some people have a strategy for that. That's great, but that's not what I do. I started off scalping, but it's really hard to scalp consistently. Sometimes you give back quite a bit, and the risk to reward isn't always balanced in your favor. So what I'm doing is I'm waiting for breakouts. Now, again, back to the chat room that I was in, when we would see consolidation like this, if price broke out of this range, they would immediately just tell us to either buy or sell. You can see down here, there's a few times where price spiked below that support low. If price would have spiked below that low, especially with economic data, the chat room moderators that I belonged to in the first year of my trading career, I was trying to take their trades. We would go short, they would call sell immediately when it would take out that low, and price would turn around and go right back up inside of consolidation. And everybody would get stopped out. And of course, the chat room moderators didn't always tell us where their stop was. They would just say either buy or sell euro dollar. I'm buying right now or I'm selling right now, whatever it was. And then they really wouldn't explain anything. And people would always say, you know, why didn't that work? Why did that trade fail again? And they would always say, well, that's just part of trading. You know, we're going to continue to work at this. We're going to take the trades when they develop, and we're going to end up with a, a larger number of winning trades than losing trades. And that really wasn't the case. That's just what everybody's hoping for. By qualifying consolidation, that's a challenge in itself, right? Because when I first started looking at consolidation like this, I saw, I didn't know what to pick. A lot of times people will say trading consolidation is really subjective because you don't know which highs and lows to use. So I started measuring the highs and lows once I saw consolidation set into place. So I would see a move like this low, this high, and then it would bounce and pull back down. There's my first pullback low right there. And at that point, you can see that everything else sort of stays above it, even though price spikes below that support low. That solidifies that support low for me. That's how I was starting to identify certain things. And then I would measure the high up here. So the high up there is 1.1370 approximately, and the low down here is 1.1324. And then I would say, if that's 50, 60 points, does that look good? Is that average? So I started studying consolidation. When it would go inside a consolidation, I started measuring the highs and the lows of that consolidation and then how long it was staying inside a consolidation. But I also incorporated the data with daily average trading ranges, because price is only going to move so far usually in certain days unless there's something, a particular reason for price to trend and break out of those ranges. So I had to take all of this into consideration. So that's how I was able to prevent myself from getting into these situations with these head fakes that these chat room moderators would call. When price was taking out support, I didn't immediately sell it. I needed to wait until a 1 hour candle closed below support or above resistance. But I also needed to make sure that support and resistance, that distance, that range that's consolidation from that high to that low, it has to be a specific number of pips. If it's too small, it will lead to a head fake. If it's not enough, it will lead to a head fake. It usually does, not always, but it usually will. Consistently, 95% of the time, if you measure and identify consolidation with the right range, and then you wait for the 1 hour candle to close, you're going to eliminate that head fake in most cases. Now, the next step after that, right, just because I get a candle that closes outside of that range does not mean that I immediately go long or short in the direction of the breakout. I need to wait for that 3 pip entry. That was another rule that I put in place for me because I kept getting stuck in head fakes just because a candle would close and then it would turn around and go right back up. I need to wait for price to take out the high or the low of the signal candle by 3 pips. When I first developed all of everything that I'm talking about, that I just explained, I started doing and applying all of this to the 30-minute chart. This is a 1 hour chart. When I was applying everything that I just described to a 30-minute chart, even though I waited for candles to close above or below support or resistance, and it was still the appropriate high and low, that consolidation range, and the indicators were confirming, if a candle closed on the half hour so let's say 10:30, 11:30, 12:30, if a candle closed on the half hour, and then I tried to take the trade, even with a 3-pip entry, I still experienced a certain percentage of head fakes and losing trades. And I couldn't figure out why. What else did I need to do? And then I went back in and I started all over again, applying the same methods. I couldn't change anything. I couldn't change the parameters of the indicators that I was using. I had to keep everything consistent so I could measure everything. So then I switched to a 1-hour time frame, and then I tested and tested and tested on a 1-hour time frame. And then I saw that because I was using the 1-hour time frame, I was almost eliminating, I can't say all of them because I still use that 3-pip entry rule, which prevents me from getting into the head fakes. But by switching from a 30-minute to a 1-hour chart, that helped me eliminate most of my head fakes. So that's why I only use the continuation breakout trade with a time frame no smaller than the 1-hour time frame. Nothing smaller than a 1-hour time frame. That's as low as I'll go, and that's for day trading purposes. I do use this strategy on the 4-hour and the daily chart. When I'm looking at the 4-hour and the daily chart, if I'm not going to execute a swing trade where I'm expecting to get into the trade and hold on to it for a while, I'm still going to use the confirmation of the breakout on the daily time frame as maybe the beginning of a trending move. And then I can try to figure out targets that I would trade if I was trading off of the daily time frame. And that's what I'm going to continue to trade it to on the 1-hour time frame, to those daily targets. But I talk about that in the membership area. So that's how I came up with the continuation breakout trade. Again, the continuation breakout trade is waiting for some event, something to happen where price eventually breaks out of the consolidation range. And then I can confirm it with these indicators, and usually confirm it with whatever that event was, whether it's economic data, political events, statements, votes, all kinds of different things. So it just depends on what that event is. It's usually news. And then I trade it in the direction of the breakout if everything works out the way it should. The indicators are confirming. I get the 3-pip entry. I understand what the economic data was that pushed it out of that range. And then I trade it to a 55-pip target here on the euro dollar. And I use a 55-pip stop loss. The indicators that I'm using. So the first indicator that I rely on here is the Bollinger Bands. I don't change the settings. I use the standard default settings here on the Bollinger Bands. And then you'll see that there's a moving average right here, the red one. This is a 50-day moving average that I use on the 1-hour time frame. And the next indicators, the two indicators down here at the bottom, this is the Cci indicator. I don't use the Woody Cci indicator on the breakout. I use the Woody's Cci indicator on the reversals. So the Woody Cci indicator on the 1-hour time frame, I set it at 14. And then I use the MACD histogram. And I don't change the settings. I use the standard default settings here on the MACD histogram. So if you watch some of the videos, when I get a breakout candle, very often I'll get the Bollinger Bands giving me the confirmation that I need, which means that on the breakout candle, whether it closes below support or above resistance, the Bollinger Bands absolutely have to be separating away from each other on the closed candle, the signal candle of the breakout. If they're not separating away from each other, then that could indicate that there's a chance that it's going to turn around and go right back up inside a consolidation or back down into consolidation, and it would be a head fake, even if it gives me the 3-pip entry. If the Bollinger Bands are not separating away from each other, I won't take the trade. There's something wrong. I'll wait and then let it move around, whether it goes up a little bit or down a little bit, and then I start looking for a reversal. And then I would switch to the reversal charts that have different indicators. I'll show you that in just a minute. So that's the first indicator that I look at on the closed, completed signal candle outside of the consolidation range, above resistance or below support. Again, if they're separating, that's step number one. That's confirmation number one. And then I go down here to the CCI and make sure that there's no divergence in the CCI indicator. And I want to make sure that the MACD is also supportive. Sometimes the MACD will lag just a little bit. That's okay. Obviously, we know it's what I know what it's going to do. As long as it's not showing me severe divergence, that's the confirmation that I need. And then I just wait for the 3-pip entry, and then I get into the trade, and I trade it from the 3-pip entry to a 55-pip take profit, and I use a 55-pip stop loss. So as I mentioned earlier, if it looks like it's going to be a head fake and things don't line up on the breakout, then I switch to a chart that looks like this, the reversals. and I go to a 1 hour time frame. But I want to see the confirmation on the 30-minute as well. So here on this chart, I'm using the Bollinger Bands again. This is my reversal chart setup. So I'm using the Bollinger Bands again. And here I'm using the Woody CCI. And again, it's set at 14. And here, the bottom two indicators, I'm using %B and bandwidth. Now, if you're not familiar with %B and bandwidth, you can go to YouTube and Google it, and John Bollinger will talk about it. John Bollinger talks about how if you were to take away all of the indicators and just let him use just two with the Bollinger Bands, he would use %B and bandwidth. And with those two, he would do just fine. I use these to indicate reversals, patterns where I can trade a bounce. So for example, if you look down here, and this is just a real rough, basic outline of the reversals. I'm not going to get into the specifics about looking for, I have a trade strategy called the T2 pattern. Very often I'm looking for bounces at major support or resistance levels. This low down here from last week, you can see the divergence in the CCI indicator, in the Woody CCI indicator. And I also look for patterns like the ghost pattern. Now I'm really specific about when I trade the Woody's ghost pattern. Obviously I didn't invent that, but I borrowed that. And then I also use certain candle patterns along with the Bollinger Bands and those two indicators to confirm that it is actually looking like a possible reversal. Sometimes we get W bottom patterns. Sometimes they're just sharp lows and then they turn around and just shoot straight back up again. They're always going to be a little bit different. But you can classify these W bottoms and tops into different categories. There's different formations that you need to learn. John Bollinger has a whole chapter on how to identify and understand the basic structure of what's going on with these W bottom patterns and confirm them along with tops. So that's a really valuable skill to have, I think, is knowing when things are going to slow down at a certain time of the day. Because again, if you're day trading, you're watching and sometimes you get the news and it'll spike out of or break out of a certain range and then it just stalls. It doesn't go anywhere and then you get that reversal. If you have the ability to confirm reversals, it's a valuable skill because you can make some money on the back end just before the end of the day, or that may be the only trade that's available. Sometimes it's just too choppy until something like that happens. Every day is going to be a little bit different. But again, this is the basics, right? So we're looking at this low here on the 1 hour time frame in price, the candle low, and you'll notice that there's severe divergence in the CCI. That's good. We want to see that. Severe divergence here in %B. And we also see that this bandwidth, you'll notice how it starts to curve its way back down. You'll notice that from that candle right there, that bullish candle, that close was 92. By the time it started to curve back down, it was still right around the 92, 95, 97 area. So you're not too far away, and then you can trade it back up, but you have to have a specific target. Now, I have some methods like the T2 pattern, the Tech 1 trade. Each one of those gives me a specific target. If you don't have a method for doing something like this, one of the things that I would recommend doing is, for example, if you were to get into this trade and you were using these indicators appropriately and correctly, and you were able to confirm this bounce here, and price was moving back up, and let's say you took the trade at 95 or 97. You need a target. I wouldn't scalp this and just start waiting for, or staring at your trading platform and looking at the dollar figure or the number of pips and then just saying, okay, I'm taking 3, I'm taking 7 next time or 9 next time. You just change it all the time. To me, and I did that in the beginning of my trading career, it just gets harder and harder. There wasn't any consistency to me that way. It was just hard. Some people like it, and for some people it's okay. It's just not the way that I like to do it. I need a specific target. And when I need or look for a specific target, I also have to be looking at the market, the timing, try to figure out, how many hours are left in the session, what kind of news is behind it, or is there going to be any news after I get into the trade? Is it likely, and is there enough momentum to expect price to even go to the target that I'm trying to trade to? So if I got in at 97, I would want to trade it to a psychological level. Now, psychological levels, and I've been using them ever since, and especially with the bounce like this, when you really don't have a clear A low, B high, C retracement, where you can use the Fibonacci tool and you think it's going to go back up to the extension targets. If we don't have that available, then I've got to trade it to psychological levels. So a psychological level would be the 00. That's one of the most important ones. The next one would be the 50, and then the 20 and the 80. So if I got in at, let's say, 97, it doesn't make any sense to take profits at the 00. That's only maybe a pip, depending on the spread. There's no point in doing that. So I would want to, or expect price to trade to the 20 psychological level, which is right about here. That wouldn't be a bad trade. There's 17, 18, 19 pips, depending on the spread. That's right over here. Sorry about that. There's 20 psychological level. The level after that would be 50. I don't even think it hit 50 here. So you scale out of the trade if you can, or you just lock in your profits right there at the 20. But again, when I get into a trade like this, depending on the timing and when something like this actually sets up and it prints the reversal, I've got to ask myself and think to myself, is there enough momentum at this time for me to get into this trade to expect price to move back up again? Is it likely? Or can you just take a moment to look at the 4-hour and the daily time frame to see if this is actually a significant support low? Is it an extension target on a ABC price swing method from the down, to the downside on the 4-hour or the daily? There's different things that you want to be looking for. Different support and resistance levels. Could it be an old trend line on the daily time frame? Different things are going to make themselves available if you just start looking and you do a little more research. You want to have multiple forms of confirmation that this is actually going to be a low, right? You don't want to get into a trade and go long and start picking bottoms when this thing turns around and goes right back up and then shoots back down one more time. You want to make sure that there's no economic data afterwards, or if that data is available after you get into the trade, is it expected to be positive or negative, have a positive or negative impact on your trade here? So in other words, if I'm going to go long euro dollar, is it going to affect the dollar negatively? Well, then we're expecting or hoping that the euro dollar is going to trail a little bit further higher and the dollar is going to continue to drop, whatever the case is. And then look at the dollar, because sometimes the dollar will give me signals. So the dollar index will give me these same signals where it looks like a sell opportunity, and then I'm identifying this bounce here. Volume. So very often you'll see me use the dollar yen. So with dollar yen, I use Japanese yen futures. That's one chart that I use, among others, a few others, that I'm using for confirmation to find yen, Japanese yen strength or weakness. I'm using the Japanese yen futures. So this is futures. This is not a cross pair or anything. You've probably seen me do that in the videos. There you can see true volume. It's not like tick volume that you see here with the MetaTrader platform. So when available, use certain currencies or indicators, things like that. They're going to show you volume, show you market momentum. Is it likely to print a reversal? Very often I see these reversals set up on the Japanese yen futures and they confirm perfectly, giving me an opportunity to trade the dollar yen, and I see volume. Volume is a really important indicator for me anyway. It should be for most people, but along with everything that I just described here with these reversals and the breakouts, it's a powerful strategy to be able to combine these methods together and have multiple forms of confirmation, not double confirmation of the same type. That's something that's a critical component. So again, the reversals, I'm also switching through to the 30-minute time frames. Sometimes I get a little more advanced notification when I'm looking at the 30-minute time frame that things are starting to set up, along with sometimes I will trade a ghost pattern on the 30-minute chart, a CCI, Woody's CCI ghost pattern on the 30-minute chart, and it will give me an early opportunity, and then it confirms with the 1 hour, a little while later. It's still just as effective as long as I use that ghost pattern at support or resistance that is significant support or resistance. I don't want to try and use the ghost pattern when it's in the middle of a downtrend, and then that downtrend or uptrend is likely to continue. You want to be careful with that. You can't use the ghost pattern every single time. You're going to experience a certain number of losing trades. I look to eliminate the possibility of some trades becoming more risky than others, and it's very often just the location. How close is it to support or resistance? If it looks like it's in the middle of a trend, then I'm probably going to stay away from it. If it looks like it's inside of consolidation, then I'm not going to use a reversal. If it's in the middle of consolidation, I'll wait till it approaches support or resistance and then gives me signs that it looks like a reversal, and sometimes that CCI ghost pattern will set up there. If you want more information about the CCI ghost pattern and how I use it, with these indicators. That CCI training, the ghost pattern, is in the membership area.